Hello and welcome to Gold and Silver Assets. So today I'm going to be talking about mining stocks, which I think are at the moment at bargain basement prices. And so this discussion will explain why I think that. So we often hear that gold miners outperform gold and provide leverage to the gold price, but is this really true? So what I've done is look at historically the gold miners versus physical gold. And we'll hopefully be able to answer these three questions. Which has been the most profitable so far? Why is this the case? And which of the two assets has the best future potential? So we'll start with this chart here, which is the AMEX Gold Bugs Index, which basically is a basket of unhedged gold stocks, and that includes 14 major gold miners. So that's another word for that, or the ticker symbol for that is the HUI index. We also have the gold price here drawn in gold. And what I've done is made a direct comparison of these from 2004 to present. And this chart shows the percentage change over that time. So it's not a price chart. If we look from 2004 up until 2008, prices track pretty closely to each other here. So neither outperformed each other, they were equal performance. However, in the 2008 episode, we had around 30% drop in the gold price, whereas the HUI index dropped a huge amount. In fact, it went below the 2004 levels. So certainly the miners outperform gold, but to the downside, which is not what you want to see. After 2009, gold shot up and made new all-time highs. However, the miners, although they rose, they didn't rise nearly as much, and they barely exceeded their 2008 peaks here. So in this period of time, although we had a nice strong bull market in gold, the miners just didn't excel. They underperformed gold. When the bear market in gold began in 2012, we saw a drop in the gold prices, which was sustained. However, the miners dropped much further, and in fact, it went even further below the 2009 levels over here. And if we look at the current prices, it's actually pretty much the same as it was in 2004, whereas the gold price is significantly higher than 2004. Here we have the HUI chart, but instead of being expressed in fiat dollars, we've expressed it in terms of gold. So the numbers that we can see here basically tell us how many ounces of gold it takes to buy one share of the HUI. So if we've got a low number, that means that the miners are cheap relative to gold, whereas a higher number means that they are more expensive relative to gold. And the historical average here has been 0.32. If we see a move in the upwards direction, that means that the miners are outperforming to the upside, whereas a downwards direction movement means that the miners are outperforming gold to the downside. And the steeper the line means the greater the outperformance. So this is very interesting here because we can see that since 2004 really, the miners have been outperforming to the downside as the general direction of the trend. And although we've had a few spikes up, basically it's just been a downwards motion. And back in 2016, we actually reached a historical low there. And we're just above that now. But the interesting thing here is that you can see that we've actually last year just broken out from this trend line. And so that makes us question whether a trend change is about to occur. It's hard to know. There are a few possibilities here. One is that we can come back down and retest that trend line, and so we'll revisit the lows of 2016. But remember, this can never go to zero. In order for it to go to zero, you'd either have to have gold go to zero, which it's never done in 5,000 years of history, so I'm pretty confident that that's not going to happen. Or the gold miners would have to all shut up shop and just stop mining gold, because either they're all bankrupt or it's just not worth doing business. And again, that's pretty unlikely, particularly if the demand for gold is high and the price of gold goes up. So this is getting pretty close to about as low as we can get. So the two directions we're more likely to go from here are either sideways or upwards. This is the BGMI to gold ratio. So that's the Barron's Gold Mining Index. And this is a useful chart because it goes much further back. It goes back to 1940. So historically, if we look at this, the miners were pretty stable relative to gold for 2 decades there. Once we got into the 1960s, there was a sharp rise with the miners outperforming gold significantly. But then the gold miners dropped off. But the interesting thing here is to remember that gold was only freely traded since 1971. And I've drawn in here the bull market in gold prices themselves. And interestingly, the miners actually did poorly relative to gold during that bull market. I'm not sure why the run-up in the miners occurred before 1971. So if anyone knows, please comment below. The other big bull market in gold was in the 2000s here, and again the miners were very lackluster in performance there. And right now, this is the really interesting thing, is we're actually below the 1940s level. So basically what this is saying is, relative to gold, the miners are cheaper than they have ever been historically. One thing I was quite interested in looking at also was, because obviously all those charts that I've shown you are for the major gold miners, but what's been happening with the juniors and the explorers. So I've managed to dig up some charts from Gold Charts R Us, and this actually is really useful because it splits up the three. So this is the Australian Majors Index, and so from 1985 to now, we can see that the prices of these miners have oscillated backwards and forwards. And right now they're still reasonably cheap. But the interesting thing is what happens when we look at this chart, which is for the juniors, and it's a pretty ugly looking chart. We had a massive bull market in the miners in the early 90s, real boom. But since then, prices have just never recovered from that, and actually things have flatlined from around 2013 to now. And so the price of juniors are pretty low at the moment. They've just been completely hammered. And then if we look at the explorers, it's even worse. So you had these massive spikes in the early 90s, and again we just never really recovered, and the overall trend has been downwards. And here we're getting pretty close to zero here. So the explorers have been suffering the most. So why have gold miners been hammered so much over the years? Well, I think there's a few reasons for this. One of the things is that we've had the introduction of things like leveraged gold ETFs and ETNs, options and futures contracts. And what these do is basically provide leverage to the gold price directly without having to have the added risks that come with the mining industry. There's been a huge uptake in those kinds of instruments as well. They're very convenient, and they're they're highly liquid. One of the other things is that because of the difficulty in raising money for mining, when they do raise money, this leads to dilution, and so the prices of these miners have diminished over time. But also you've got other sectors that are taking away money from this industry. So things like crypto, tech sector and marijuana stocks, they're all just siphoning money away from the speculative money that would have ordinarily gone to mining in the past. So is there going to be another mining boom, or is this trend just going to continue with particularly explorers dying off over time? Well, if we want to see another mining boom, then I think there are a few things that need to happen. So one is we need a good, strong bull market in gold, which will certainly help. But remember that we've had bull markets in gold in the past, and the miners still haven't necessarily done so well in those. So we actually need a few other factors to come into play. One of them is that we actually need asset classes that are currently in bubbles to burst. So a crash in other asset classes could potentially bring money into the gold mining sector. This would particularly be important if we've got institutional investors coming in, and of course the boom will be in full swing once we get more retail involvement. So I still think the future is still bright for the gold mining industry, but it's still really important to hold physical gold, as we've already seen in this discussion. So thanks for listening, and don't forget to like and subscribe. Bye.